to another episode of Thirsty Thursdays, where I sip on a refreshing drink and bring your thirst for knowledge a quencher, so to speak. Hey, so today I was at the grocery store and purchased GT's Synergy Energy raw kombucha. This flavor is Trilogy, which is a fermented tea that contains over 9 billion living probiotics. So it looks like it's about 50 calories, only 12 carbs, and carbonated. Holy smokes. It's supposed to be healthy, I guess. So let's see how that goes. Woo-ha. Okay. That kicks harder than Bruce Lee, man. Kombucha! Alright, back to it. So, one question that was brought up was, why are the mortgage rates so high? So, team, let me just kind of start by saying that it isn't worse than 1981, guys, where the federal rate was 16.63% on average, I think. That means that the lender's rate would have been into the 20% range plus, and your APR even being higher even than that. So, with that said, 6 to 8% rates don't seem so bad, do they? Granted that they are higher, I'm not saying that, and they're a lot higher than the 2 to 4% rates that we've seen in the COVID years, but I don't know if we'll ever get back down to that low. You have to kind of remember that interest rates are influenced by various factors beyond your control, such as economic conditions and central bank policies. While you can take steps to help mitigate the impact, it's essential to stay informed and adapt your strategy accordingly. So, moving forward, there are a few ways to help combat the rise in interest rates. Number one, you can refinance your mortgage. So if the interest rates are rising, but you have an adjustable rate mortgage, or an ARM is what it's called, consider refinancing to a fixed rate mortgage. And then that way, you hear the 30-year fixed or 15-year fixed. That's perfect. And then that way, before the rates increase further, locking in a lower fixed rate could actually provide stability and potentially save you money in the long run. Secondly, improve your credit score. Obviously, a higher credit score can help qualify you better for a better interest rate. That includes paying your bills on time, reducing your overall debt, and maintaining a low credit utilization ratio. Just regularly check your credit report for errors and address any discrepancies promptly. A great way to do that is through Credit Karma. The score is definitely off. It's not your FICO score that we pull or anything like that, but it is a great way to monitor, and that's what that is. It's a monitoring system, so you see things coming in, going out, paying on time, late payments, or whatever the case may be. You'll see it all there. Number 3, pay points. So this is where I hop in and kind of help out. Mortgage points are upfront fees paid to the lender in exchange for a lower interest rate. If you don't know what that is, you can kind of look that up, or you can call me, but each point typically costs about 1% of the loan amount and can lower the interest rate by a certain percentage. So basically just calculate whether paying points makes financial sense based on your goals and how long you expect to stay in the home. So if you're only going to be expecting to be there for 3 years, it doesn't make sense. If this is your dream home and you're going to be here for 20 plus years, absolutely. Number 4, optimize your budget. Review your finances and look for areas where you can cut expenses or increase your income. So basically by freeing up additional funds, you can allocate them towards your mortgage payments and potentially pay off the loan faster, therefore minimizing the impact of the rising interest rates. Also, number 5, you can seek professional advice. So consult with a mortgage broker, me, or maybe your financial advisor. If you don't have one, I have a few that I can send you to. But someone that knows their stuff, who can provide personalized guidance based on your specific circumstances. They can help you navigate through the options and programs available, analyze the long-term costs, and even assist you in making informed decisions. So for example, I know that I get excited whenever a loan product can help the borrowers and the real estate partners, which is exactly what the conventional 1% down does, as an example. And so basically, when income qualified borrowers put down 1% down on to the loan, our lender pays an additional 2% toward the down payment, up to $4,000, for a total of 3% down. So not only does it help make home ownership more affordable for the borrowers, it also makes for a competitive edge in my market to help with more families. And so this is how this could actually help the borrower's case. First and foremost, it creates more opportunity to help borrowers who need it the most. It follows the same guidelines as Home Possible and Home Ready. It's a lower down payment, obviously. You get into the house sooner by reaching the down payment savings goal faster. There's more money allotted there for furniture and house repairs and maintenance, or equity. Who wants a $4,000 equity all automatically and only having to pay 1% down? It's a no-brainer. What you have to do as a borrower to qualify, you have to have an income at or below 80% of the AMI, which is the area median income. So in Oklahoma, for example, it's $65,000 or less total gross income coming in. You do have to have a FICO score of 620 or above, and it needs to be a 30-year fixed loan with an LTV or loan-to-value ratio of 97%. And then you just have to be eligible for a primary purchase. So it can't be an investment home or something like that. 4 questions about the conventional 1% down or any of our down payment assistance programs. Comment below, DM, or connect with me by phone or email. I am available to you. Guys, be sure to follow or subscribe, and of course like, as this helps me be able to make more helpful videos. And as always, make it a great day.